Hi, it's Chris Lewis from Daily Forex, and in this video I'll be taking a look at Elliott wave theory. Now, this is a primer. This is not a complete course on Elliott wave. It's a hugely complex topic, but this gives you a good introduction and a good understanding of what this Elliott wave theory is all about. It was based on a book Ralph Nelson Elliott released in 1938 called the Elliott Wave Principle. And the Elliott Wave Principle suggests that the collective psychology of investors, known as crowd psychology, moves between optimism and pessimism on somewhat natural sequences. The psychological ebb and flow will be evident in the pricing of markets over time. So what I mean by that is he had noted in nature sound waves, light waves, those type of things. There seem to be repeating patterns, and that's what this is based upon. So in some sense, it's like Fibonacci. Now, there are 5 waves, and I will draw out what a Elliott wave move might look like. So you can see that you can make 5 different waves on this imaginary price chart. And there are some basic tenets to this. Number 2, wave 2, which is corrective in nature, cannot take out wave 1. Wave 3 cannot be the shortest of the impulse waves, which is the trend following waves, and it's not. And wave 4 is just a simple pullback to wave 5. Now, wave 4 cannot overlap with wave 1, meaning that you couldn't drop down below there. So you can already see one of the major problems with Elliott wave is that it's overly complex. So with that in mind, it tends to be one of those things that either you get it and you use it or you don't. There are 2 types of waves in Elliott wave. There is impulsive, which goes, in this case, upwards with the trend 1, 3, and 5, and corrective, which goes against the trend, as you would expect. A corrective wave is a correction of the longer-term trend, and that is waves 2 and 4. So on the Turkish lira Japanese yen daily chart I have in front of you, you can see that we had a big gap to start the week during this week back in 2017. You can make an argument for a corrective wave or an impulsive wave done in magenta here and corrective waves done in blue. And by doing so, you fulfill the Elliott wave principle. You can see that wave 1 came down, wave 2 came back, did not take out wave 1. Wave 3 was the longest of the impulsive waves. It was much more aggressive. Wave 4 did not, very importantly, did not overlap with wave 1, and then we broke down to wave 5. So that's a bit of a perfect example, if you will, of Elliott wave analysis. There's also the possibility of being 8 waves, sometimes even more. And this is where Elliott wave theory gets lost on a lot of people. And what that is, it's very much like the 5 pattern in the sense, or the 5 wave pattern in the sense that you have impulsive waves. In this case, you'd have 5. And then you would have retraces of A, B, and C. So you'd have wave 1, 1 A, B, and C, wave 2, A, B, and C, and so on. And that in and of itself explains why Elliott wave is very difficult to use. Now, ironically, Elliott wave is followed quite extensively on Wall Street and places like that. So it certainly has its place as a tool in your toolbox of indicators. It is possible to use Elliott wave on all time frames, but with all things technical analysis, and Elliott isn't going to be any different, the higher the time frame, the better off you are. It eliminates a lot of noise because there are a lot more trades involved in making that happen. So before I leave you, let's take a look at an uptrend Elliott wave count. This is Aussie dollar Japanese yen 4-hour chart. And you can see that we had a significant move to the upside from a area of significant support, from where you can tell, plainly due to the several times we had tested there. We had pulled back, but not wiped out the first wave. Again, very important. And then had a very strong impulsive wave to the upside. And this is the wave that everybody tries to catch. From there, we had what would have been thought of as a retrace. So that'd be a wave 4. And then eventually we got wave 5 going, and that was a 5-count wave. My experience has been that 5-count waves are much easier to deal with than 8, just simply because they are a lot more straightforward. So essentially what you're looking for is a trend. You're looking for the retraces to not take out the previous impulsive wave, and you want the third, the middle part of the trend, to be the impulsive part where you pick up the most momentum. Simply put, it's yet another tool that you can use. It's something that you should at least be aware of. But there's an old joke that says if you get 5 Elliott wave traders in the same room, you'll get 5 different Elliott wave counts. So keep that in mind. It's not something that I trade upon solely, but I certainly can use it to give me an idea as to where we are in the process of trending.